Investors, hello! This is Stock AI Insights, your chief AI analyst. Just a reminder, this is for educational reference only and not investment advice, because investing always involves risk. Today, we are parsing IBIT ETF nears bottom as Bitcoin targets reversal from That's Trading News. Now, the headlines are screaming crypto crash, but what if the data is telling a completely different story? Let's dig in.
All right, let's not sugarcoat it. The last month has been rough. BlackRock's powerhouse Bitcoin ETF, IBIT, has taken a pretty brutal 15% drop. If you're holding, yeah, that definitely stings, and it's the reason for a lot of the anxiety we're all feeling right now. And then you see this number, nearly $3.8 billion pulled from Bitcoin ETFs in a single month. Now, on the surface, that looks like a total 5-alarm panic. So, is everyone just bailing? Is this the big one? Well, maybe not. And that's exactly what we're here to figure out. So, to really understand what's going on beneath the surface, here's how we're going to break it down. First, we'll look at why the market's under so much pressure. Then, we'll see who's actually holding steady. We're going to unpack those huge outflows, talk about fear and opportunity, analyze the charts, and finally, put it all together. Okay, first things first, the market is absolutely getting hammered, and there's no denying it. A huge part of this is something called deleveraging. It's really just a chain reaction. Traders who borrowed money to make bigger bets are getting forced to sell, which pushes the price down, which forces more people to sell. It's a classic domino effect. But, and this is a huge but, this is where the story gets really interesting. While all the headlines are focused on panic selling, if you look a little closer, you see something else entirely. Let's talk about the so-called smart money, the big institutions. Are they running for the hills with everyone else? You might be surprised. Just look at this. We're talking about the biggest names on Wall Street: Millennium, Goldman Sachs, Brevan Howard. These guys are sitting on positions worth over $1 billion each. They aren't just holding on, they are dug in. That's not fear, folks. That is some serious conviction. Okay, so this is the central mystery, right? How can the big dogs be holding steady while it looks like nearly $4 billion just walked out the door? Well, it's because that massive headline number is frankly really misleading. It all comes down to a clever little strategy called basis spread arbitrage. Don't worry, it sounds way more complicated than it is. It's kind of like this. Imagine you see the exact same TV for sale at Target for $500 and at Best Buy for $505. You could, in theory, buy it at Target and sell it at Best Buy at the exact same time and pocket that $5 difference. That's what hedge funds were doing, not betting on Bitcoin's price, just profiting from that tiny price gap between the ETF and the futures market. So here's what happened step by step. The funds put on this trade, but then that little price gap they were profiting from started to disappear. So to lock in their gains, they had to close the whole trade out, sell the ETF, and buy back the futures short at the same time. And when you sell billions of dollars worth of an ETF to close a trade, what does that look like on paper? Yep, a massive, scary-looking outflow. I love this metaphor. It is spot on. From the outside, it looks like total chaos, like the building's coming down. You see all this debris and think it's demolition. But on the inside, it's just a planned strategic move to make the structure stronger. Those outflows weren't panic, they were just construction. So, if we can't trust the outflow numbers to tell us about fear, what can we trust? Well, let's look at the market's actual emotions. As the old saying goes, you want to be greedy when others are fearful, and right now, fear is off the charts. Check out this chart. This is a big one. We're looking at implied volatility, which is basically a measure of fear, and it's spiking up to that 60% level. What's so special about that? Well, you can see that historically, that's the panic zone, where sellers finally run out of steam and the market tends to find a bottom. The rubber band is stretched about as far as it can go. And you can feel it everywhere. Demand for puts, think of them as insurance against a price crash, is at the 97th percentile. That is an insane number. It's what we call capitulation. It's that final, get me out at any price moment that, more often than not, marks the point of maximum opportunity. All right, so the emotions are screaming bottom. But does the chart itself agree? Let's dive into the technicals and see what they're telling us. Has the sell-off actually run its course? Now, let's be real here. The source is very clear that the IBIT chart on its own still looks pretty rough. You've got this bear-stacked EMA structure, which basically just confirms that the downward pressure we've been feeling is very real. No one is arguing with that. But, and here's the key,
Look where the price is headed. It's dropping right into a major support zone, somewhere between 55 and 57 bucks. You can think of this as a historical floor, an area where in the past a flood of buyers has shown up to defend the price. We're knocking on that door right now.
Okay, but this is the real headline from the technical side of things. Bitcoin itself, the actual underlying asset, has just tagged its key correction target of $77,000. So according to this analysis, the technical sell-off has done its job. It's hit its mark. The cycle might just be complete.
All right, let's pull all these threads together. We've looked at the big money, we've debunked the scary headlines, we've gauged the market's fear, and we've checked the charts. So what is the final verdict? What's the big picture? Okay, so here's the contrarian case for a bottom, all laid out. You've got the institutional bedrock, the big firms are staying put, the arbitrage unwind, meaning those outflows were just a technicality, not a vote of no confidence. You have that massive volatility spike signaling extreme fear, which often happens at lows. The technicals show Bitcoin has hit its target. And finally, on-chain data shows that the smart money wallets are actually buying this dip. You put that all together, and the story really changes. And that leaves us with this final question. With all this evidence pointing to a bottom, is the extreme fear we're seeing in the market a warning sign to stay away, or is it the welcome sign that contrarians have been waiting for? Pulse verdict. The data suggests the recent market panic may be a technical illusion, masking underlying institutional conviction. We'd love to hear your thoughts in the comments. See you in the next episode.